Okay, so we're going to get started. Good afternoon, everyone. It's my pleasure to welcome you all here. My name is Venky Venkateswaran, and I'm delighted to welcome you all to the 19th NYU Stern Economic and Market Outlook Forum. The forum is hosted by the Center for Global Economy and Business at Stern, which serves the university through outreach to the broader community, including academic, policy, and business worlds, as well as students and alumni. We're pleased to have in the audience several students and faculty from all over NYU, as well as many alums. I want to welcome you all and thank you very much for joining us. So today's session will last 90 minutes. It'll begin with presentations of about 10 minutes by each of the panelists about economic and market prospects, followed by a Q&A session. So we'll finish by 6:30 p.m. Eastern Daylight Time. For the Q&A session, I would encourage all of you to enter your questions through the Q&A feature. In moderating the session, I'll try to curate and kind of limit repetition by grouping similar questions together. Please add your name. We're not going to permit anonymous questions. With that, I'm going to turn to introduce our distinguished panelists, starting with Dana Peterson, who is the chief economist and center leader of economy, strategy, and finance at the Conference Board. Before that, she spent several years at Citi, where she served as a global economist, as well as in the public sector at the Federal Reserve Board in Washington, D.C. She's a board member of the National Bureau of Economic Research, first vice chair of the NYABE, and a member of the NABE, as well as the Council of Foreign Relations. She holds an undergraduate degree in economics from Wesleyan University and a Master of Science in Economics from the University of Wisconsin-Madison. Welcome, Dana. Our second panelist is Peter Hooper, who is the Global Head of Economic Research at Deutsche Bank, an institution he joined after a very distinguished career at the Federal Reserve Board in DC. Hooper currently serves as a member and former chairman of the Economic Advisory Committee of the American Bankers Association. He's a founding member of the U.S. Monetary Policy Forum and a member of the Economic Leadership Council at the University of Michigan, among several other ones. He holds a PhD in economics from Michigan and has published numerous books, journal articles, and reviews on economics and policy issues. Finally, our third panelist is Ethan Harris, who is the head of global economics research at Bank of America, before which he was the chief US economist at Lehman Brothers. He's also spent time at Barclays and JP Morgan, as well as at the Federal Reserve Bank of New York, where he was an assistant to the president and head of the domestic research division. He's a founding member of the U.S. Monetary Policy Forum, a member of the World Economic Forum Community of Chief Economists, and a member of the Economic Advisory Committee of the American Bankers Association. He holds a PhD from Columbia University and is the author of Ben Bernanke's Fed. Welcome, Peter, and welcome, Ethan. Welcome to all of you. So with that, I'm going to kind of turn it over to each of our panelists. We're going to start with Dana, followed by Peter, and then Ethan for initial remarks, after which we'll kick off the Q&A. So with that, Dana, the floor is yours.
Professor Venky, thank you so much for the invitation. Going to share. Okay, so I'm going to start at like 50,000 feet, then come down to around 30,000 feet. Oops. Let's see. All right, there we are. So just starting off with what's driving the global economic recovery, the US and China. So this interplay between the US and strong demand for consumption of goods and China's willingness, or rather desire, but inability to produce all the goods that US consumers want, is generating inflation globally. So what does this mean? Well, essentially, with the onset of the pandemic, government restrictions, a fear factor, combination of things meant that consumers in the US decided that they were basically just going to consume goods and not consume in-person services. Initially because they couldn't, and then over the time of the pandemic, and certainly up until now with the Delta variant swirling around, many people are choosing not to engage in in-person services. So there's still heavy demand for goods. Meanwhile, in China, initially, when the pandemic affected China, the first round, there were closures of factories, and supply chains became very disrupted. Fast forwarding to now, once again, factories are closing in China as well as ASEAN nations that are producing goods. And then even if the goods get produced, they're getting stuck out at sea because you have shortages of shipping containers. And then once it reaches the shores of the US, there's not enough people to unload those ships. And then there aren't enough truckers to move the goods across the country. So all of those factors are contributing to what we're seeing in terms of inflation. Now, a lot of these are, some of the inflationary pressures that we're seeing are transitory, while some we think are a little bit more persistent, and I'll get into that in a second. So what else is driving the US economic recovery? Copious amounts of monetary and fiscal policy stimulus. The chart on the left-hand side, everyone's familiar with, that's the Fed's balance sheet, which the Fed is signaling that it's going to start tapering large-scale asset purchases. Meanwhile, the federal government, if you take a look on the other side, has provided some liquidity supports, but mainly copious amounts of spending in the form of checks to individuals and households, families with children, as well as PPP money to business and other supports to businesses and state and local governments. So that's providing, those stimulus measures are providing plenty of liquidity for households and to a lesser degree to businesses to engage in this spending. Where's the US in the role of this recovery in terms of the race? Well, the US has already achieved its pre-pandemic level of GDP growth. So at this point, we'd say the US is no longer in recovery, but in an expansion. And so we've seen very strong GDP growth for the US. Even with the Delta variant curbing activity right now, we still think the US can probably grow around 5.5% this year, which is quite strong, especially when prior to that, we were growing around 2.5%. This is what I'm talking about. If we look at global goods consumption, the US is that navy blue line on the left-hand side is driving consumption and of goods. And then we look at the other side of the page, services consumption. This is through the second quarter, was starting to tick up a little bit, but certainly we know from a more real-time data that consumption weakened a little bit associated with Delta, but also because of these backlogs. People are ordering things and not able, or at least not able to see those orders fulfilled. Meanwhile, you have China trying its hardest to export goods to the US. And these data, unfortunately, a little bit dated. This is through June, but we know from anecdotal reports that exports have weakened from China and also several ASEAN economies, contributing to inflation. So here's the Delta variant. And you can see that right now, the US and the UK are really driving the increases in cases associated specifically with the Delta variant. The good news is that the US has done fairly well with 61% of the population vaccinated, well, at least with one vaccine. Still, we're only about 50% in terms of total vaccinations. And because of this, we're seeing cases rise, right? And so that's interrupting economic activity. Meanwhile, you see restrictions in the US have increased since July. So the Delta variant is still really affecting the US. I'm going to skip over some of this stuff because it's not really pertaining to inflation. But we are seeing that certainly with the housing market, very strong demand, very weak supply. And so prices have really spiked, though we don't think that there's going to be necessarily another financial market crisis associated with some kind of housing crash. And that's because when we look at metrics for consumers, they're better relative to 2005, 2007. And also when we look at who's holding these mortgage assets, you have the federal government, i.e. the taxpayer, on the hook, but nonetheless, the federal government implicitly will back the GSEs. You also have banks with better risk metrics. So, for example, tier one risk-based capital is at the highest percentage ever, which is great. And then when we look at mortgage trusts, which are REITs, they can fundamentally be that market can be backstopped by the Fed in terms of mortgage-backed security purchases. Now we're coming down to 30,000 feet here in terms of US inflation. The reason why I gave you that backstory is everyone's complaining about inflation, but everyone can just look in the mirror in terms of, playing their role in helping these inflationary pressures that we've seen throughout the pandemic. So very strong demand for goods. Meanwhile, you have backlogs for these goods. And so that means prices are rising along with them. Meanwhile, on the other side of the page, you can see Indonesia, Vietnam, Malaysia, Taiwan, factory activity just collapsed associated with the Delta variant. So this is telling us that whatever inflationary pressures we're seeing, and yes, the CPI data today saw a smaller than expected month-on-month increase, we could see a resurgence of those big increases in month-on-month prices. But still, in all, the year-on-year prices are probably going to remain pretty elevated for some time. And I'll define that. But again, some of the factors that are inducing inflation, in our view, are transitory, meaning directly a result of the pandemic and should ease once we're beyond the pandemic. And then there are other factors that we believe are more structural, meaning there's been a material and significant shift in the way things are done such that these pricing pressures are going to be with us a little bit longer. So let's take a look at producer prices here. So I mentioned truck transportation and freight and containers, right? So there was somewhat of a container shortage before the pandemic. It's only worsened because of amid the pandemic. And meanwhile, we're seeing prices for trucking rise because of all the demand for goods and not enough people, right? So that should fade, certainly as consumers in the US feel more comfortable going out and engaging in in-person services and have a more balanced diet between consumption of goods and consumption of in-person services. Meanwhile, if we look on the other side, we think that the elevated lumber prices, even though they've come off, they're still up 60% year on year. And also for chips, those things are probably going to be with us, those inflationary pressures. Why lumber and plywood? Well, work from home is here to stay. And so there's very strong demand for people to move to bigger places where they can actually have an office, right? And then also we have millennials. Many of you watching, or some of you, depending upon how old you are millennials. And millennials for many years were held back in terms of engaging in those milestones of life. But now millennials, many of you are working. Many of you have been able to pay down some of your student loan debt. Some of you have been able to save. You're pairing off, you're having children, and you want to buy that first house. And so between work from home and millennials, we think there's going to be continued underlying demand for housing. Meanwhile, if we look at the chips, well, the pandemic has created a chip shortage. But even once the pandemic is over, digitization has happened. Consumers are purchasing things online. They're enjoying movies and things, all sorts of things online, and they're into their gadgets, and they're going to continue to desire those things, which require chips. And it takes 5 to 10 years to build a new chip factory. So given that, we're thinking that these types of inflation, at least for producers, are going to stick. I'm going to skip over this. It gets a little confusing. Now let's take a look at consumer prices. And this is what the prior chart is telling us, that there are certain factors, certain pressures on consumer prices that we think are a function of the pandemic and should cool off. And then there are other prices that are also pandemic related, but are consistent with reopening of the economy. So if we look at consumer prices increases based on backlogs, certainly for motor vehicles and gadgets, a lot of that's a function of chips, the chip shortage, but also very strong demand. So I just mentioned in the previous slide that some of this stuff is probably going to be with us. So I would suggest that, yes, consumer prices are rising on backlogs for these two, but we may not see as much of a cool off because of the chip surge. Meanwhile, with reopening, bars and restaurant prices and also air transportation, i.e. Airline tickets, have surged. And that's a function of the fact that these businesses have been closed. All of a sudden, earlier in the summer, there was high demand for these types of firms. Meanwhile, commodity prices were sky high for food and energy and transportation. And guess what? You couldn't find people to work for you, right? So wage pressures increase, and all these costs businesses basically passed on to the consumer. But as again, if we have a much more balanced diet of goods and services consumption, this sort of pricing power, these pricing pressures, and also the pricing power that these businesses are engaging in is probably going to fade. When we think about home prices, yes, on the left-hand side, we have the Case-Shiller home price index, and that has pretty much gone vertical. Again, a lot of that's strong demand for fundamental reasons. Interest rates are low. Millennials want housing and work from home. Meanwhile, supply is insufficient. We've underinvested in housing since the financial crisis. There's also a lack of buildable land and few laborers. If we look on the other side of the page, rents, meanwhile, have been depressed during the pandemic. Now, our view is that these prices are probably going to normalize for rents for a couple of reasons. Number one, all the folks who are having difficulty finding housing in the short run, probably going to look to rent, right? So that's going to place upward pressure on rents. Also, all the young people who went home to live with mom and dad through the pandemic are starting to think about going back to the cities, right? And so that's going to drive up rents. So we see upward pressure from rental costs and OER and the CPI, or the equivalent in the PCE. And so that's going to place upward pressure on prices over the next year or so, we think. So what about the Fed? Circuit breakers. I think that there are several sets of metrics that the Fed is watching very closely, such that if one or more of these become out of control or untenable, the Fed may blink. And I'll explain what I mean by blinking in a second. So one key circuit breaker is financial market inflation expectations. Those inflation expectations seem like they've come off a little bit, and they are not matching what we're seeing in terms of core PCE inflation. So markets, the Fed might interpret this to say, well, markets are thinking that, yes, some of these inflationary pressures are transitory, temporary, they'll go away when the pandemic goes, right? And so this is not becoming embedded. Another measure, this is the competition, the University of Michigan, but we're all friends here because the Conference Board also has inflation expectations, but we don't have a long-term inflation expectations measure. And certainly when we look at this, there's been the delta over the course of the pandemic seems pretty severe. You went from almost no inflation expectations to, yes, inflation expectations being higher. But historically speaking, long-term inflation expectations, which are a factor in actual inflation, are pretty low. And so the Fed would look at this and say, okay, inflation expectations are still historically low, but we're going to pay attention to the deltas here. Another circuit breaker is really where we are in the labor market recovery, because the Fed has a dual mandate, and that one of the mandates is full employment. And that is not just defined by whatever U3 or the unemployment rate is doing. The Fed cares about a ton of labor market metrics. And when the Fed looks at the labor market right now, it sees very low participation rates among men and women. More than half the people who are unemployed are women, and unemployment rates relative to the natural rate of unemployment for Black and Latino workers is still really high, even though the national unemployment rate has come off. So the Fed is going to be looking at this, and essentially, they have this kind of fulsome view of what full employment looks like. And as long as full employment is not wherever they think it should be, that's going to give them some pause in terms of the degree to removal of accommodation. Also, the Phillips curve, I think, whatever people think about it, here we have three different regimes, right? And the latest regime, the second latest is 1995 through March of 2021. And so those are those gray dots. And so you can see there was a much weaker relationship, still there, but a much weaker relationship between low unemployment and high core consumer price inflation. So, but what I did was I broke out the readings from April through July of this year, and they seem to be pretty elevated in a prior regime. So the question is, are these, readings just, or not just, but mainly a function of transitory factors? Or have we really leapt up into a higher regime where we're going to see higher inflation? So that's a key question. So I think the Fed's going to be, if the Fed has this chart, they're going to be watching this chart. Another circuit breaker is growth, right? And not just the headline, but the composition of growth. And so far, the composition of growth has been pretty lopsided, mainly consumption of goods. And you can see that here. I mean, we've seen a little bit of a switching over to services, but still in all the levels of services consumption, as I showed you earlier, well below where they were pre-pandemic. And also inventories, where businesses basically shipped everything that they could, ran their shelves bare, and now they're trying to restock. But guess what? It's very difficult to restock when you can't move product, right, across the seas, or you can't produce it, and then whatever's produced, you can't move it, you can't ship it. So I think as long as the growth is still kind of lopsided, the Fed might have some pause. But also equally important is, where's the output gap? Are we looking at a notably positive output gap next year? And so that would give the Fed some cover to say, well, maybe we can move it a little bit more quickly. Another circuit breaker is what's going on in wage inflation. So on the left-hand side, we've got the ECI. So this is essentially through the second quarter, because that's as far as it goes. But you can see that most of the wage inflation is in areas that kind of make sense and are associated with the pandemic. But the key issue is, do you create this negative cycle of wage inflation that turns into consumer inflation, and in turn becomes more wage inflation? You have this inflationary spiral. So I think, the Fed's going to be looking very closely at that. And then finally, the last circuit breakers, expectations of economists. What are we thinking? And so far, street economists are anticipating that the first full rate hike is in the second quarter of 2023. And the Fed has worked really hard to kind of decouple quantitative easing from interest rates, right? And the Fed's saying, look, based upon growth, and growth has been astounding for the U.S., even though very lopsided. But we've done well. Based upon that, we can start tapering assets. Maybe before the end of this year. We'll find out more news from the Fed next week. But then there's still this nagging question of inflation. And here I have the street's latest. Unfortunately, I think this was from August. What was in Bloomberg in terms of expectations for the end of year core inflation rates. And then you see what the Conference Board has. We're above consensus. And then you can see in that red box what the Fed's been anticipating. And so the Fed, I think is putting a lot of weight on the transitory element. And then with the average inflation targeting regime, the Fed is saying, well, it's fine if we don't go back to 2%, as long as we're hovering somewhere around 2%. Why? Because we've missed for so many years. And so there are tons of questions. And I think, the key thing, and I'll stop sharing, is with the removal of accommodative policy, can the Fed adequately communicate this decoupling between quantitative easing and interest rate hikes, and also manage expectations around inflation, right? Do people feel comfortable, the markets feel comfortable, and the consumer feel comfortable that the Fed can address inflation, especially if these pressures persist for longer amid the Delta variant surge, or not? And so I guess I'll stop there. But a lot of questions here in regards to inflation in the US and how the Fed's going to respond. Thanks, Venky.
Sure, Dana. Thank you so much. Our next speaker will be Peter Hooper. Peter, you can go ahead and share your screen and take it away.
Thanks very much, Venky. And I anticipated we'd get a comprehensive and efficient presentation from Dana. So I'm going to, on the overall outlook, I'm going to focus on the inflation side a bit more and take it from a historical perspective. So just to kind of review the consensus view here, the recent surge in inflation is very much transitory. Inflation expectations although they've been rising, are still well anchored. Inflation is expected eventually to return to 2% or lower a year or two out. The Fed is generally not expected to raise rates until sometime in 2023, a couple of years from now. All that said, as people present their consensus forecast in the same breath, they say the upside risks are rising. So I'm going to focus on those upside risks a bit and drill down to a couple of very interesting charts that Dana presented. We'll look at the output gap and that key driver of the Phillips curve, how it's changed pre and post the Volcker period. We'll take a look at some of the upside risks from the massive fiscal stimulus, giving us the risk of a repeat of the mid-60s takeoff in inflation. And then finally, a few comments about the Fed's new flexible average inflation targeting regime and how that could get us into some risks as well. So to start off, the output gap, looking at things over a little longer history than Dana put up there, but going back to the 50s, during the 50s, 60s, and 70s, this measure of real GDP relative to potential averaged well above zero. The economy was generally on the hot side, output running above potential on average over that period. It did, of course, lead to high inflation, as we'll see. Volcker came in. We had the Volcker disinflation, and the Fed shifted pretty dramatically from being an institution that was willing to react to inflation to one that wanted to act preemptively to avoid inflationary situations. So in the period since 1980, the output gap has generally averaged well into negative territory. The economy has seen a lot more slack than tight periods. The peak level that we got over the last 4 decades was in the late 90s when we reached just about 2%, 2 percentage points. And of course, what we're seeing now is most consensus forecasts get us back somewhere into the 2 to 4% range on output gap over the next few years. And it doesn't take too much to get us into a higher growth scenario, which will get the output gap back up into the 5-6% range, which clearly would spell some danger. So just to go back and look at the last big inflation scenario that we've had. This zooms in on the output gap during the 60s and early 70s. Again, the dark line there. The output gap coming out of the 1960 recession rose gradually, economy recovering. By the mid-60s, it had passed through 3% positive, something we haven't seen since then, and on its way up to 5-6%. Now, the inflation rate, core PCE, on the left scale there during the first half of the 60s, of course, remained quite subdued for much of that period in the 1 to 2% range. And as the economy got into overheated state, it began to rise. And certainly in 66, started the year at 1.5%, ended the year above 3%, and was moved up from there. Now the Fed reacted, but very mildly during this period. The economy continued to motor along at an upward gap of 3% plus until it really stepped on the brakes in the late 60s, bringing on a sharp drop in output, the recession of 1970, which eventually did level off and eventually slow inflation, although only temporarily, because the Fed turned around pretty quickly and inflation rose again. So looking beyond we've been focusing on the box lower left. Of course, we went into the high inflation period, helped along by some oil shocks and some other factors. This brought along Paul Volcker and the disinflation. And the Fed, of course, succeeded remarkably well in bringing down inflation and getting it under control. In fact, over-succeeded to the point where inflation over the last couple decades has been running below desired levels, average core PCE inflation averaging noticeably below 2%. And inflation expectations, longer-term inflation expectations, actually moving lower, a bit low for comfort as well. Not sure if you can see it at the very end here, but this very low inflation period brought on the shift in Fed policy regime following a policy review during 2019. In 2020, we got the shift to flexible average inflation targeting just before inflation surprised substantially to the upside. Now, the FOMC's median projection of inflation for this year in December last year was 1.8%. The consensus was a bit above that, but no one was expecting to get it back up into 4% plus on year-over-year core PCE inflation this year. Yes, it is transitory for many reasons, but there are a couple risk factors going forward that we need to be mindful of. Now, I'm not talking about risk of getting back up into the 1970s near double-digit inflation. I'm talking about a risk of a repeat of what happened in the box at the left, the mid-60s takeoff. One risk is of course, the inflation expectations, which are what I'm showing in this chart is the Fed's common index of inflation expectations and average, basically an average of a number of different surveys, et cetera. We've done one in-house that's a little more up to date. Basically, inflation expectations are now back about in line with the level, maybe a little above its pre-2014 average, but about in line with the level that would be consistent with the Fed's inflation objective. But it has risen very, very, very rapidly. And if inflation stays somewhat elevated, given the adaptive nature of this series, inflation expectations are basically a function of what's been happening with inflation itself in recent history. They could rise further, and that then feed into an inflation process. That's one risk. The bigger risk, I think, is that we get back into a more heated level of the output gap. And here, drilling down into what all this fiscal stimulus that we've gotten has done, personal income growth shown in this chart, nominal personal income, normally declines in recessions. This time around, as you see at far right, it's acted very, very differently. We've seen an unusually large increase in personal income during and following an economic downturn. Of course, the reason here being a series of several massive fiscal support packages, giving us a huge gap between take-home pay, X transfers, and what's actually happened to personal income. A huge boost, which has had the effect of raising household saving rates tremendously. The household saving rate going into this recent period had a baseline level of around 7.5%. That was elevated in part because of cutbacks in spending during COVID, but elevated tremendously because of the series of fiscal stimulus packages. Now, the net effect of this stimulus has been to raise the accumulated saving over the last year and a half by about 10% of GDP above where it would have been as a 7.5% baseline. The consensus forecast going forward basically assumes that this saving is going to be treated largely as wealth. It'll be spent out very slowly over time. Saving rates are not going to fall appreciably. And that helps bring, say, the economy in for a soft landing, slows growth, takes out some of the inflation pressure, allows the Fed to move relatively slowly over time. I think in addition to the income risk, we've seen large increases in household wealth during this cycle. Last year, net worth relative to income rose. Net worth rose by nearly a year worth of income, and as Dana noted as well on the right, home prices have continued up at a pretty rapid pace. The stock market has continued up. So certainly the upper income portion of households, which account for a pretty large share of overall consumer spending, have a lot of wherewithal to spend. A reduction in the saving rate by 2 or 3 percentage points is enough to get us a long way toward that substantially higher path for the output gap that we looked at earlier. Let me just finish with an observation about the Fed's new flexible average inflation targeting. It hasn't been terribly clear exactly how it's going to implement this target. We don't have folks are basically assuming that the Fed is going to be averaging over something like a 3 to 5 year period and look back. And on that basis, inflation is already running above targets. So there's not a lot of room to run. And if inflation does persist somewhat higher over the next year or pick up significantly more than currently expected as we get into 22, latter part of 22 and 23 with some additional rise in that output gap, the Fed's going to have to, if it's going to live up to a 3 to 5 year look back and stick to its guns, it's going to have to act more aggressively, and you increase the chances of seeing the kind of mild recession that we saw at the end of the 1960s following that liftoff in inflation that we had initially. Of course, the risk of getting into something a bigger problem is if the Fed has a longer look back, if there's more patience, if we're looking at something like a 10-year moving average of inflation, we have quite a ways room to run. And that raises the chances of, I think, things getting embedded, a bigger inflation down the road, and something moving maybe toward what Volcker had to deal with a much bigger cost to the economy eventually. So just to wrap up, bottom line, just very simply, inflation risk rises over the next couple of years if the lagged effects of fiscal stimulus further elevate the output gap, and if the Fed is unduly patient about inflation overshoots under its new flexible average inflation targeting regime. Thank you.
Thank you so much, Peter. So our next panelist, our next speaker is Ethan. The floor, or rather the screen, is all yours.
All right, thank you very much. And I am not going to share charts with you today. I think we're charted out by now. I have a very similar view to Peter and Dana. And so what I would like to do is kind of zero in on, take a little bit of a step back and think about why this is all happening. Because I think we all agree that you're going to have you have tremendously stimulative policy, a very strong economic recovery, and rising risk of a significant increase in inflation. And so what's driving all this in terms of the thinking in Washington? And I want to kind of really get to the guts of this. I think part of the issue here is, as Peter pointed out, people have kind of forgotten their history lessons. I mean, the 1960s is a long time ago. And what is informing views around the economy, particularly in Washington, is what happened in the last business cycle when the economy refused to recover. And it just took forever to get the economy back to full employment. And you didn't seem to be able to get an inflation higher. That kind of failure of policy in the last cycle is informing decisions today in a very big way. I think that's the wrong analogy, and this is the fundamental disconnect in Washington. Right now, if you look at the outlook for the U.S. economy, this looks nothing like the last cycle. We're coming out of a very quickly out of recession. We have 3 times as much fiscal stimulus as we had coming out of the last cycle. We have more persistent fiscal stimulus. And in fact, if you look at every other central bank around the world, and every other fiscal authority around the world, we're the most dovish. We have the most dovish central bank, most dovish fiscal authorities, with unprecedented policy regime shift by both monetary and fiscal policy. And if you look at the fundamentals driving the economy right now, not only do you have massive monetary and fiscal stimulus, but you've built up these kind of momentum effects in the economy. I mean, the recovery in the economy has resulted in a collapse of inventories because companies can't keep up with demand. And so you've got this pent-up demand for increased production because inventories are so low. As Peter talked about, you've got all this excess savings sitting around here from last year. And what's striking to me is, he talked about the $2 trillion in excess savings. What's really striking to me is how much of that is still sitting in people's bank accounts. So last year, when you couldn't buy services, when you're getting all these stimulus checks and all this fiscal money coming out, where did all that money go? Well, it didn't go into the economy. It went into people's savings accounts and checking accounts. There's actually $3.5 trillion of dry powder sitting there in bank accounts. And as Peter pointed out, if it was really wealth that they're not planning on spending it all, why did they just leave it in the bank, right? So there's a lot of potential delayed fiscal stimulus as the economy reopens from all that fiscal policy. So it's not just what we did in fiscal policy last year or what they're contemplating this year, it's the leftover stimulus on people's bank accounts. And then the final area where you see this pent-up activity is the labor market, right? Why did the job market slow in August? Is the economy stumbling to a halt? No, it's because there's a big limited, a lot of constraints on supply. So if you look over the last 6 months or so, businesses have increased their demand for workers, but they haven't been able to fill the jobs. So there's roughly 2 million unfilled jobs above and beyond the normal level of job openings in the economy. And in August, that constraint on supply of workers got particularly bad because COVID got worse. So you've got a pent-up demand for workers. And if you look at all these things, you look at the delayed spending, you look at the inability to rebuild inventories, the inability to hire workers, all of that stuff gets unleashed if COVID gets under control. COVID right now is having a very big impact on the supply side of the US and global economy. Think about what's going on in the service sector, okay? So if I'm a worker in a high-touch industry, which are, like a restaurant or a hotel or something that involves interaction heavily with the public, and I'm a risk-averse person, I don't want to work. I'm going to stay home. If I'm not worried about COVID, if I'm a relatively relaxed about the risks of COVID, I've already gone back to work. I'm already working at the restaurant. So you can imagine what's happened to that remaining group sitting on the sidelines when COVID picked up. They all looked at this and said, whoops, maybe I'll wait a little longer to go back to the job market. So when people talk about the strength of the recovery in the economy, there's a lot of potential pent-up spending, hiring, and inventory rebuilding that's waiting in the wings to drive the recovery going forward. We don't need more fiscal stimulus. We don't need any impetus. We just need to see COVID contained. And so I very much agree with Peter's view around a very rapid GDP growth, creating a very large positive output gap in the next couple of years. Now that brings us to inflation then. So what's going on there? Well, the Fed would like you to believe that it's all temporary, right? That this is not a problem. It's, used cars and computer chips, and it'll all go away when the economy reopens. There's some truth to that. There's no question that there's a lot of special factors driving inflation. And as the economy reopens, those supply constraints will ease. However, I think there are three reasons to take this a bit more seriously, and would put me more in the worried camp of Peter in terms of inflation. The first is that, remember that in the last cycle, again, people take the wrong lessons from the last cycle. In the last cycle, the reason inflation didn't pick up when the economy got hot was because inflation expectations fell sharply at the end of the business expansion. So for those of you who've taken intermediate macro, which I assume is everyone on this call, will remember the Phillips curve has two components. You've got the level of the Phillips curve, which is determined by inflation expectations, and you have the slope that's determined by the sensitivity of inflation to unemployment or the output gap. Well, what you had in the last cycle was the Phillips curve shifting down even as unemployment went along the curve towards higher inflation. So the two components of the Phillips curve canceled each other out late in the last business cycle. Well, as Peter noted, and Dana had a chart on this as well, inflation expectations have already picked up. We're already back to where we were before that fading of expectations. So one of the areas where the inflation story is already showing up very early in this cycle is inflation expectations. And I don't think there's anything fluky about this, right? If the government says we're going to write a blank check on fiscal policy, and if the Fed tells you we're going to definitely overshoot on inflation, I believe it. If I'm watching these massive spending policies, the very aggressive Federal Reserve policy. So I think that inflation expectations have picked up partly because they've convinced people they're going to succeed in exactly what they're telling us they want to do. They want a red hot labor market, both the fiscal authorities and the Fed. And so I don't think this is a fluke that inflation expectations have picked up, and that will, over time, generate actual inflation. The second reason for concern or for believing that there's a sustained rise in inflation is that if you look at the details, and including today's CPI report, there are a lot of components that are not being driven by special factors that have picked up. And the most important of them, as Dana pointed out, is rent and owner equivalent rent. Important part of the price indexes we all look at, that is already accelerating, and as she pointed out, is likely to continue to accelerate going forward. So some of this is already happening in the more sustained components. It's not just used car prices going up. And then the final point I would make is that there's a lot of talk about the inflation being temporary now, and that next year we go back to normal. I would put it the other way around. I would say that next year we're going to have a brief period where inflation fades a bit because these hot sectors like used car prices come down. But we're going to very quickly move into the later stage of the business cycle where you have more permanent shortages, where you have a very low unemployment rate, where you've got very little spare capacity. totally unrelated to COVID and all the stuff going on now. So you'll go from these temporary shortage situations to more of what you normally get late in the cycle when there's a big shortage in the economy. So I think the temporary part of this inflation story is what's going to happen in the beginning of next year when inflation comes down a bit, whereas the permanent story here is a gradual upward trend in inflation once you strip out all the special factors. Final thing I wanted to talk about, so I certainly agree that the risk is that inflation gets too hot here, given how hot the economy is going to remain. Final thing I wanted to say is, why is it, I think that this comes up with clients all the time, why are they doing this? Why is it that suddenly both the Fed and fiscal authorities are like throwing away the rule book and hitting the accelerator full force? Why do we have fiscal policy 3 times the last business cycle and bigger than any other country in the world as a share of GDP? Why do we have such a big stimulus? And why do we have the Fed rewriting the rule book? Why is the Fed announced that they not only want to hit their target, they want to overshoot their target, they want to overshoot full employment, and they want to have a red hot labor market that helps disadvantaged workers, right? Why is it that both of them have decided at the same time to do this? I think a lot of it comes back to what part of history they're learning their lesson from. And what they're getting their lesson from is the last business cycle. This isn't like the last business cycle. We don't have a crippled housing and banking system. We don't have a fiscal policy that suddenly stops before the economy's recovered. We've got massive fiscal policy. We don't have a Fed that's trying to preempt inflation. So they're trying to change their policy before inflation picks up rather than after it picks up. So we're in and we don't have the crippled, we've got great household worth as Peter pointed out. We got a great banking system. Well, at least my bank. We've got a great banking system, and we've got a great housing market. So none of the stuff that was the headwinds of the last business cycle exists in this business cycle. So I think that it's just the wrong time frame. And then the final thing I would say on this is on the fiscal front, there's an even more dramatic story at play here. And that is that Americans and politicians in particular have learned to ignore deficits. Why is that? Well, part of it's because economists have cried wolf too many times about how there's going to be a big crisis because we've got these big debts, and it just never seems to happen. Part of it's because both parties have developed intellectual cover for running big deficits. So if I'm a Republican, I can look at kind of steroid supply side economics on steroids and argue, oh, don't worry about tax cuts. They're going to pay for themselves. We're going to have a ripping economy, and we don't have to worry that cutting taxes raises fiscal deficits. Well, we saw what happened with the Trump tax cut. It absolutely was wrong, but that kind of mythology around supercharged supply side economics continues to be a nice intellectual cover for cutting taxes and not imposing any budget discipline. And then on the Democrats, not to be outdone, you've got theories kind of like on steroids, Keynesian theories like modern monetary theory that says, don't worry about deficits. You can spend whatever you want. And if inflation picks up eventually, then maybe you should be a little more cautious. So the two parties have the intellectual cover to pursue their two different versions of deficit-financed fiscal policy. And then in addition, the partisanship in Washington is putting an additional pressure on the Biden administration to get everything done as fast as possible. The reason why they keep trotting out one fiscal bill after another is they know the midterms are coming. They know that the incumbent party tends to lose in the midterms, either lose the House or the Senate, where they have almost it's virtually a tie in both houses of Congress. So the risk is quite high of them losing control of one of the houses. And they know that if they lose control of one of the houses, their whole agenda is dead because Washington will go into full-blown gridlock. So there's an additional element of pressure to get things done well before the midterms. And really the only constraint on the Democratic Party right now is the moderates like Joe Manchin who are saying, I don't want to go in for the $3.5 trillion, but I'm happy to do big stimulus plans. So you've got both the Fed and fiscal authorities simultaneously adopting unusually aggressive policy. And our gauge of this is that on both counts, the US is the most dovish policy combination in the world. We are the most dovish central bank and the most dovish fiscal policy. So I'm going to stop there and turn things back to Venky, and I guess we can get some Q&A going.
Wonderful. Well, I want to start off by thanking all three of you for an extremely, very illuminating, very interesting kind of overview and this thing. I recognized or I realized there were lots of overlapping themes. So I'm going to start my Q&A partly from where Ethan's kind of overview ended, which is on fiscal policy. So I wanted to get your thoughts on all three of you, your thoughts on the recent fiscal initiatives. And there are multiple parts to that. One of them is this infrastructure bill, and then there is the other part which involves spending on a whole range of new initiatives which is the thing which is the $3.5 trillion package that Ethan alluded to. So I wanted to kind of ask you what your thoughts on those were, both in terms of what are the somewhat longer term implications? Are these things going to actually unleash or unlock some hidden productivity potential in the US economy? And then, kind of tie it back to our theme of the day, inflation, and how, these things are going to kind of feed into inflationary expectations and through inflation. And so maybe we can go back in the same order we came. So Ethan, Peter, and Dana, if you can just, I'd let you hand off to each other as you go along. So go ahead, Ethan. I'll let you.
Oh, okay. So I think we need to think about different aspects of what we're seeing in fiscal policy. During the height of the pandemic, you absolutely needed massive fiscal stimulus. Probably not quite as much as we got because so much of it ended up in people's bank accounts, but you absolutely needed it. And so that is, appropriate fiscal policy. Then as you go into the new year and the economy is already red hot, you're now throwing more stimulus into the economy. I didn't understand the $1.9 trillion package. I mean, why do we want to send out more stimulus checks to people when their bank accounts are already packed with funds? And so the fiscal policy, instead of becoming very targeted towards the remaining pain points in the economy, has continued to roll out at record levels. Now, as we go forward, I think, again, you have to think about what's needed and what isn't. So the conventional infrastructure and to some degree the climate change efforts, to me, seem like they're a very practical approach to something that really needs to get done. I mean, the infrastructure of the U.S. is terrible, as folks at NYU know if they've commuted in and out of the city ever. Just go down to the subway anytime and you'll find out. And so we need an infrastructure. And so you can argue that there's some productivity enhancements from that. Even better, it would be nice if we actually were funding it with a gas tax or some kind of revenue increase rather than with deficits. So there's some value in that. On the next package, I think what happens is the moderate Democrats water the whole thing down. So you won't get $3.5 trillion, you'll get $1.5 trillion maybe. You're not going to get all of the tax hikes that have been proposed by the House. I don't see Joe Manchin and the other moderates agreeing to that. So what you're going to get is some kind of corporate increase, some kind of increase in taxes on upper income people and on capital gains, but everything gets watered down. But it still leaves you with this package that's going to be more deficit than tax financed, and therefore adds a little extra layer of overheating to an economy that's probably already overheating next year. So that's my view on it. Peter?
Okay, I'll say that I think Larry Summers had it right when he observed that it's unfortunate that we're putting all this resources into padding savings accounts rather than putting it, investing it where it can be more productive. I think there is a pretty strong bipartisan agreement that, as Ethan notes, we need more investment in infrastructure, broadly defined, and that probably would add noticeably to productivity growth down the road. As you go beyond the infrastructure spending and into a number of initiatives, the Democratic Party would like, I happen to think that there's quite a bit there that would be beneficial in terms of raising productivity potentially in terms of education, in terms of other support for households, et cetera. But I agree that this is going to be very tough politically. The moderates are not going to go along with the high spending. My sense is probably we end up with something that maybe adds a 0.5 percentage point to GDP spread over a year or two, with some tax offset to the spending increase that we get there. But I am optimistic we'll get enough on the infrastructure side to add to potential growth.
We did an analysis of the package when it first was launched or floated out to the public earlier this year, and so we kind of scored everything together, the raw infrastructure as well as all the human infrastructure, and you could, right now they're breaking these pieces apart, but the point is that, the raw spending, I agree with Ethan, that's going to provide, like, the rollout for that's going to be more immediate. So that's going to provide a boost to GDP growth and a little bit more inflation in the very short run. When we looked at the components of the infrastructure plan, at least back in April, I think that's when it was released, March, April, a lot of it was based upon fixing what's broken. And for those of us who like to talk about multipliers, the multipliers for fixing what's broken tend to be smaller than for just building new stuff. So we're, in terms of what we've incorporated into our forecast, we have incorporated some kind of infrastructure bill, roughly $1 trillion, but it doesn't provide much of a boost in the short run because it has very long run rates for the output. And then it probably doesn't provide much of a boost over the longer run in terms of total factor productivity, because you're just kind of fixing what's broken and you're not adding any new or much in the way of any new infrastructure. So, it's, we're non-political. We don't make any political statements, but just from, just the raw analysis, that's just kind of where we see things headed, if any portions of these two bills get passed. So in the short run, a bit of a boost from the raw spending, not much from the infrastructure over time.
Thank you so much. So another question, which I think is related to a number of questions, both in the Q&A box and some that I received earlier about inflation. So I want to kind of come back to that theme. And let me try and maybe articulate, or at least summarize those different points of view in the following way. So part of what's complicating the picture right now is our inability, and perhaps to some extent, the Fed's inability to distinguish between or disentangle these transitory disturbances from these more sustained inflationary pressures. And as all of you mentioned to varying degrees, over time, hopefully that inference problem or that difficulty is mitigated as we see, to the extent that there are sustained inflationary pressures, we're going to see them in sectors all over the place. And hopefully that will kind of signal or make it clear that there are inflationary pressures. What I wanted to ask you was, do you see a significant risk that at that point, the Fed continues to kind of drink the Kool-Aid, as to use a colorful phrase, and kind of ignore those signals and learn from the wrong period of history, Or do you actually see, the Fed kind of changing gears relatively quickly when something like that comes along? And again, let's go Dana, Peter, Ethan, in that order.
Sure. It seems like Peter's always in the middle.
Oh yeah, maybe I should mix that up a little bit next. I will
Sure.
do it next time.
I've watched the Fed for not as long as some of the other folks on the call, but for a while. And we're dealing with some very brilliant people. And I mean, I agree with Ethan that the Fed has kind of shifted its focus more in terms of, inequality and addressing those issues that, really manifested themselves over the last decade and a half. And certainly were social, political issues over the last couple of years. But I think that the Fed, we're dealing with folks who also are historians and would turn on a dime if they needed to. Again, I had all those different circuit breakers, and I truly believe that if a number of those circuit breakers are breached, inflation expectations rising too quickly by too much, market expectations for action increase, that the Fed's going to act. And certainly the Fed, we've noticed since the great financial crisis that the Fed is kind of, led by the nose a little bit by financial markets. And so I think if you have a combination of not only consumers, but also financial markets and economists expecting action, that the Fed will probably comply, and that it's not going to just sit back and allow a crisis to happen. Or maybe I've drunk in the Kool-Aid, I don't know.
So I'll hold the Fed's feet to the fire here a little bit. The average rate of inflation over the last 3 to 5 years is now above 2%, core PCE. There's no longer any reason for them to want to overshoot in order to get inflation expectations back up because they've been too low. Okay, when they set their forecast for inflation in December at 1.8% for core PCE, they weren't anticipating the kind of events that we've been through here that have changed the picture. Okay, so if inflation falls the way they anticipate, if it comes back down to 2% a year from now, okay, and stays there and maybe goes a little below, if it's in that vicinity, then they can continue on their current advertised path of holding off raising rates until sometime in 2023. But if, for the various reasons that Dana's put forth and Ethan, we get inflation remaining higher for longer, given I'm going to say, okay, they had this new regime, let's stick to it. They're going to have to act more rapidly to get out of this, out of getting into a bigger problem down the road.
Yeah, I agree that there's a risk the Fed waits too long and then has to hit the brakes very hard. And I think that here's the challenge for the Fed, right? Inflation models stink; they don't work very well, and they've adopted a policy where they're saying we're only going to react when we see the whites of the eyes of inflation. It has to be there. We have to be sure it's sustained. And so there's a high risk that it hits them and they're late. And in fact, one of the things that I find striking in the Fed commentary is a lot has changed this year. So as we came into the new year, some things happened that should have had a big impact on Fed thinking. One of them was the sweep by Democrats. And then the fact that Democrats took full advantage of that sweep to push through much bigger than expected fiscal packages. And yet the Fed's commentary didn't seem to change at all. They just kind of said that's great that they're doing that. The Fed's commentary didn't change when vaccines came rolling out twice as fast as anyone's expected. Their rhetoric has been pretty stable in the face of some pretty high inflation numbers. It feels like they're going to err on the side of going too late. And we know, and this is where old folks like me and Peter get nervous, we know that once inflation gets going, it isn't that easy to get it back under control. That was the whole story of the 1970s, is that every time the Fed thought about trying to control inflation, they found out it's really costly, and they backed off. and let it keep going. I think if for folks on the watching the show here, when you look at the Fed, remember, particularly Powell, remember the way he's interpreting the economy is from a risk management point of view. What he's saying is, I want to be absolutely certain we hit our targets and overshoot our targets. And therefore, he's very focused on the risk on the left tail of the distribution, that we don't get a full recovery, that we don't get inflation picking up on a sustained basis. He's putting a lot of weight on that. On the other hand, when you listen to an economist like the three of us, they're looking at the center of the distribution as their baseline and putting equal weight on the two ends of the tails of the distribution. I think that this kind of glass half empty, never acknowledge inflation's really picking up, and never acknowledge just how strong the economy is. I think that's based on his focus on avoiding that left tail at all costs. And by the way, when you look at the commentary from the rest of the Fed, so if you look at, for example, the CEP forecast the Fed publishes after their meeting, that is a baseline forecast. It's not a risk kind of adjusted thing that the way Powell describes the economy. And that's one of the reasons why I think that the CEP feels more hawkish than him. It's not that he disagrees with what the forecasts of the rest of the committee are. It's that they're giving their central tendency, and he's thinking of this from a risk management point of view of avoiding at all cost a replay of the last 20 years where they couldn't hit their inflation target. That's my view on it.
Great, that was very illuminating. So one other maybe more kind of, whatever the low level or an immediate tactical question on this, and then I want to shift to other topics. On the labor market, I know all of you in your summaries kind of touched upon different aspects of the labor market. One thing I want to kind of focus on is the so-called infamous worker shortage and the wage pressures that are coming as a result of that. So there were, obviously a lot of ink has been spilled, coming up with explanations for that, ranging from, it's the nervousness about the virus that's keeping people away. It is the, unusually generous unemployment benefits that are keeping people away. And all of those things have contributed to a shortage and therefore higher pressures on wages. And we saw that in the most recent report, where even though it was weaker, there was signs of upward wage pressures. Do you guys anticipate that dynamic changing, given the recent expiration of the unemployment benefits and perhaps some kind of moderation of the virus in the coming months? In other words, is there going to be an anti-inflationary force coming from people coming back, or people being either more willing or being forced to work because they no longer have an unemployment check to count on? So this time, to kind of break my order, I'll start with Peter, Ethan, and then Dana.
The New York Fed does an interesting survey of consumers in which they ask a question about reservation wages. At what wage would you be willing to go back to work or take a job? And for much of last year into this year, those reservation wages were rising, particularly for lower income folks. In the last, between the last two surveys since early spring, they've been going the other way. Reservation wages have been falling. People are saying they're more willing to come back to work, and probably yes, this was somewhat pre the worst news on Delta, but it was also in anticipation of the ending of the unemployment benefit. So I think all of the above have been factors. Just one more thing. Our U.S. econ team, headed by Matt Lazzetti, has done some very nice work looking across county level data. And the finding is that things line up most closely. The labor market conditions relative to COVID, relative to unemployment benefits, et cetera. It appears that the delta is the most important factor. The holding people back, and maybe when you consider broadly the extent to which that has impacts on not just willingness to go back to work, but also ability, given availability of daycare, et cetera, a factor.
Yeah, I don't buy the Republican talking points that we get rid of unemployment insurance and everyone goes back to work. I'll say that much. I think that the challenge here is it's just going to take a while for things to come back. As I said, if the job openings data suggests that I think it was actually like 11 out of the last 12 months, job openings have gone up or something. And you're going to have to work, before you're going to have to get those workers all back at some point. I do think that it's very sensitive to COVID. As I said earlier, I think if you look at divide the population of people who went back early in the crisis and ones who have been staying on the sidelines, they're different kinds of people. So I think that this pause we're seeing right now is just, people are risk averse, just saying, no, not going to do it. Now it's going to take a few months though to get them to really get moving on this and to start working through that inventory of unfilled jobs. But I do think that we may get another soft September, but probably by October, the labor market's starting to loosen up again, and you might end up getting some pretty strong payroll numbers at that point, given all the unfilled jobs. So I think it's just going to take a little while to get things going, and it's going to take quite a while to reverse that huge excess supply. So we're going to have a lot of potential job growth for a while here as those people get hired.
Just looking at the last jobs report, or at least the last few jobs reports, most of the delta from one month to the next was being driven by in-person services. And so there were 0 jobs in leisure and hospitality added in August. And that, I think, is fully a function of Delta, right? People pulled back, said, we're not going on vacation, we're not going out to restaurants. In some states you couldn't. And so there was no job growth there. But I think that there are 3 other factors in addition to the ones that Peter and Ethan mentioned in terms of why you have this, labor shortage. A big one is the fact that children are not fully back at school. And so that's affecting labor market activity, especially for mothers, because in a lot of households, the responsibility of, homeschooling is falling to mothers. So a lot of women are still not back in the labor market because their kids are not physically at school. I think that there's another reason why I think we're not going to recoup all the jobs. Well, not another, but a reason why we're still probably going to see a gap is that tons of people have retired. Either due to, they were close to retirement, they feared getting infected, or they, don't really want to work, in the office anymore, or, they've benefited from the stimulus checks, all sorts of reasons for why people have retired, and they're not coming back, right? And that's going to run up against severe labor shortages that we're going to find in the next few years that Peter alluded to, particularly because of demographic issues. We're going to have more people retiring than becoming aging into the age range for work. And then another thing, this is really interesting that the Harvard Business Review published about a week ago, is that there are tons of people who are applying for these open jobs, but they're not getting them because of technology, where you essentially have these AI algorithms that are not picking up on these people because either their skills don't match, it's hard to map them because you're a veteran, right? Or, you had a gap in employment due to the pandemic, you put that on your resume, the algorithm boots you out. And then another issue is that I think businesses are having difficulty finding the right kind of worker. And so what we've been noticing is that businesses have been changing their desire for skills, kind of lowering the threshold with the intent of training these people once they come in. And so I think, these are additional reasons for why we're seeing these bottlenecks, in terms of hiring and this mismatch between the number of jobs that are just available and people to fill those positions.
So Venky, I have some practical advice to your audience here, especially the students.
Fire away.
Yeah, well, one of the things I've discovered through my son and his job search is there's an arms war going on in job searching because you got all this stuff online. And so all these companies have these programs that sort through resumes, and your resume has to check all the boxes for it to be picked up. Even if you're a great person for the job, if the machine doesn't recognize you, they won't give you an interview. Well, the counterplay to that is to employ one of these companies that mimics those search machines and do that to your own resume. And it works. Now, the problem, of course, this is all inefficient from a society basis because everyone's competing to see who can game the other guy better. But anyways, I thought that if you get nothing else out of this presentation, some advice about how to get your resume picked up is...
That's right. I think we should probably add a class on how to game the system. This is the radar blocker of the day, I think. So one other, so I want to kind of switch gears, maybe talk a little bit about other topics. And one of the things I wanted to talk about, and this is something, it piggybacks on something Ethan mentioned. I know we're all kind of focused on COVID and the trajectory of the virus and the rest of the Greek alphabet as it comes rolling along. What other risks do you guys see or maybe have fallen by the wayside in that discussion? Financial stability, is there deleveraging risks in some parts of the economy? There's always so I just wanted to get your thoughts on, as something you mentioned, Ethan, earlier, that, what is lurking in the left tail of the distribution that we should probably, have at the back of our minds, even if it's not the most important factor that's going to drive near-term outcomes. So again, I don't know, why did I start with Ethan, Peter, and then Dana?
Yeah, I mean, I would mention two very briefly. One is I do think there's financial stability risks because, if let's say the Fed is making a mistake here, and which I don't know, maybe they are, maybe they're not. We're going to find out. And they're waiting too long to hike. And then it all comes backloaded. Well, the markets are getting kind of lulled to sleep a bit with this no rate hikes anywhere in sight environment. And so it's a kind of environment that can create bubbles in asset markets. And then when the Fed takes away the punch bowl abruptly, you could end up with a financial accident. It's one of the reasons why the Fed normally taps on the brakes a little bit early. So that's one risk. The other one is U.S.-China relations, right? We don't really know exactly what the new equilibrium is here. We know that Xi is consolidating his power in China. He wants China recognized as a superpower. And he's a bit of a bull in the China shop over there in Asia. I don't know, a bull in a non-China shop, I guess. And we don't, and it's going to be very awkward to reach a détente between the Western democracies with open markets and a state kind of driven economy that's stopped moving towards the free market and started moving back towards state-sponsored activity. So there's a lot of risks in that, particularly of a tech war coming back in a big way.
So Ethan has hit my big three. I mean, COVID-related variants, certainly inflation and Fed, as we've been talking about, and geopolitical with China at the head. I suppose very near term, looking at the politics in Washington, I'm getting a little worried about things like debt ceiling. We could see some fireworks that could be disruptive. I mean, it wasn't that long ago we had a downgrading of U.S. Treasury debt, and I guess it was Ethan was talking about the general acceptance here, market equanimity about debt and deficits, but certainly that could come to the fore if indeed Mitch McConnell stands by his words that he's not going to allow the debt ceiling to rise if there's any spending by Democrats.
Sure. Each of the things that Ethan and Peter mentioned are on my laundry list. In fact, in my deck, I have like a whole list. I didn't bore anybody with it. But I would say that, certainly deglobalization and protectionism are kind of tied together as big issues for us in terms of things that keep me up at night. Certainly, and this is also tied to the geopolitical element in terms of the US-China relationship, where you have economies, Europe, China, the US, all engaging in some form, and the US on the cusp of industrial policies that kind of roll back, the globalization of trade and the globalization in terms of human capital and free movement of people, and even the free movement of capital itself, where you have bans on where you can invest, and also demands on where you can place your supply chains and source goods, and not travel bans, but, restrictions on visas in terms of who can come in and out. And all of these things have implications for not only GDP growth in terms of reducing global trade, but also reducing domestic demand and creating inflationary pressures. And it's all coming at a really bad time. And certainly the pandemic has exacerbated these existing feelings that were pre-existent before the pandemic, and just kind of made these issues even more important to focus on. So I would say that, certainly looking at supply chains, industrial policies, the tech war that Ethan mentioned, these are the things that all contribute to deglobalization. And, as an economist, we view that as a negative for growth and certainly inflationary.
So I think that ties into what is perhaps my last substantive question before I give you a few minutes to this thing. Has to do with, is there, we've spent a lot of time talking about the US and both monetary, fiscal policy and other factors. But, this, the COVID pandemic in particular has had, somewhat similar effects on public debt and, and policy all over the world, especially and to some extent even more dramatically in some parts of the emerging world. So one thing I wanted to ask you is to put on your global economist hats back on and see, is there risk brewing in emerging markets or in other parts of the world, which we should be kind of on, which should be on our radars. So I'm going to start with Dana and then Peter and Ethan.
Sure. I definitely think that there are financial stability risks. A number of emerging markets have already started raising interest rates because they're concerned about their credibility in terms of fighting inflation and maintaining stable currency markets. But they also run the risk of cutting their nascent recovery short, and still finding themselves in a situation where they're heavily indebted, because a number of emerging markets took on a ton of debt, at least initially during the pandemic. And they also didn't have vaccines. So they said, well, where do we invest, right? And when you look at the IMF's forecast, very few economies are actually going to be reducing the amount of debt that they will have on their sovereign balance sheets. Most economies are going to see an increase over the next 5 years. So I'm very concerned about financial stability risks in terms of emerging markets, and then also in terms of what the Fed does in terms of the Fed's policies having this ripple effect throughout global financial markets and feeding into currency movements and flows of capital for these emerging markets.
I was going to pick up on exactly that point. I mean, I think the sensitivity to, we've been focusing on the inflation risk domestically in the U.S., but the sensitivity of emerging markets, especially, and a number of advanced economies in Europe and elsewhere, to a Fed that suddenly had to turn aggressive, that would be painful.
Yeah, the only thing I would add is the COVID crisis is really awful for the weakest countries in the world. I mean, they're not getting vaccines. They don't have fiscal space to offset the shock to their economies. it's a real tragedy happening quietly. These are countries that we generally don't cover because they're not important financial markets. But going beyond kind of the traditional emerging markets that we're talking about here that could have capital flight problems and so on, it's just bad, to see what's going on with the unequal distribution of vaccines and so on for countries that need it desperately.
So what I want to conclude with, and we'll just take another minute of everybody's time. I know we're already at the scheduled time. I just wanted to pick all your brains for a brief, advice to our students who are interested in careers in finance or economics. All of you have a perspective that I think that would be invaluable for them at this stage in their careers. So whatever advice Ethan already gave us, they should hire, resume. I don't know what the service is called.
Resume robot or something.
But any thoughts, any brief thoughts on what you would like to communicate to them? And I think we'll end on that note.
Well, having had two careers now, one at the Fed for 26 years and another at Deutsche Bank for almost as long. Hard to say. They're both wonderful. I mean, public service at the Federal Reserve, and as Dana observed, there's a lot of brilliant people there. So if you're at all inclined in that direction, I certainly would not discourage it. And it's a good place as a takeoff for the private sector. I guess that would be the. I had one other quick thought, but that's the main one. I think I wouldn't want to sell short the public sector here by any stretch.
Yes, I'd have to agree with Peter. Certainly, the brief time that I spent at the Fed as an intern definitely gave me a halo effect that lasted throughout, to this point in my career. But I would encourage everyone to just kind of explore the public sector, the private sector, and academia. It's great to do all of them, and also policy, all four. So wherever you start your career, think about kind of dipping your toes in all those different areas so that you can have a very broad and well-versed portfolio.
Yeah, I'll give the advice I gave right before the financial crisis. I was speaking at a college about career stuff in the economy, and a guy who's going to come to Lehman Brothers to work, and he asked me and of course this is right before my company went under, right? He asked me, where should I go in the firm? I said, pick the safest department you can find and stay away from mortgages. Yeah. I think that the simple advice is the one that everyone gives, which is networking, asking questions, find something you really like, that you love, and so you get up for, and it's more than just making money.
If you're on the way to graduate school, taking a couple of years ahead of that to try it out is really, really very valuable.
Wonderful. So I want to start out by thanking our panelists. This was fantastic. We covered a lot of ground, and you guys made it very interesting, engaging, and accessible for everyone. So I really want to express the gratitude of all of us here in doing that. I also want to thank all the participants for all your Q&A. I'm sorry we didn't get to all of them. I'll try and save a transcript and send it off to the panelists, and they can process it as they deem fit. But I want to thank you all for staying and participating. Two quick things. One, I want to shout out to Jonathan, who has kind of helped organize this. He's been on the call, and he's kind of made these things happen on at the back end, and he's been remarkable. So this wouldn't have happened without him. And finally, the center has another event next Friday where John Taylor is going to talk about monetary policy after the pandemic. So John already thinks that the pandemic is behind us, perhaps. But, so I encourage all of you to attend, and you can find the details on the center website. I encourage all of you to attend, and I hope to see all of you there. With that, I'm going to kind of end the session. And again, thank you all for a fantastic session.
Thank you.
Thank you.